Well, thank you for joining us today. I'm Chris Mellone. I'm a partner and financial advisor here at VLP.
Hi, I'm Sean Beznicki. I'm the Director of Investments at VLP.
Sean, thanks for taking a couple minutes for us here today. We thought that your blog post that you recently wrote was really timely, given a lot of the volatility that we've seen in the markets on the back of some of the uncertainty that we've had recently with the change in administration. So we thought it would be great to revisit some of the core points that you pointed out involving fixed income, and just wanted to unpack that with you today.
Sounds great.
Cool. So the first one, correlations does not eliminate diversification. Why don't we talk about really what that means and then how we integrate that into our process?
Absolutely. When we think about correlations between equities and fixed income, typically they have an inverse relationship where equities would tend to go up, and if that were the case, fixed income typically goes down. And that's a relationship that has held true for many years. Sometimes that relationship does, in fact, turn on its head, and I'll point to some of the major global financial crises where all correlations went to one, regardless if you were real estate in the equities and fixed income. Moments like that, when there's major drawdowns in the market and investor confidence is shaken, that can have a massive effect, and you see these macro headwinds across all sectors. The thing is that when you get through something like COVID, and that had a major implications on the global markets, that can then have an effect on both fixed income and equities. And then on top of that, you have things like inflation and Fed policy. It can definitely have a material effect on the way that both of these asset classes can perform. And again, it's a relationship that does hold true. And the further out you go, the more likely you'll see that relationship is strong. Of course, in today's environment, it may look a little different, but correlations are still they're still there. They just aren't perhaps have the magnitude that they maybe did 5 or 10 years ago.
Yeah, for sure. And I think as what we talk about a lot of the times is the behavioral piece where recency bias comes into play, where 2022 was the worst year that we've had really in history for bonds. So that stung where interest rates really rose rapidly, and bonds were in some instances down more than 10%. So there's been that sort of back of the mind, piece here. Hey, if inflation does pick back up, if rates go back up, could we see, a negative contribution from bonds? And obviously that was atypical historically, and we think that's likely to be the case going forward. So your second point, correlations are dynamic and evolve over time. This is something that we've really seen come to a head the last couple of weeks.
When you have, again, all those major factors, including geopolitical risks, again, Fed tampering or tariff situations, that actually plays into this more of an uncertainty. And what people tend to often forget is that uncertainty itself can be a major risk factor. You look at something like 2019, where tariffs were on the table, we had a rising rate environment. So much of that uncertainty actually weighed on investors so much that treasuries caught a bid, and inflation expectations actually started to reduce, despite the fact that, similar to today, we had a slew of tariffs that were set to implement. And what did the Fed end up doing was they actually ended up lowering rates. So you have to look at sort of what the environment that you're playing in, and you cannot just solely depend on, typically just the correlations, because again, they can be dynamic, they can change, and there are a confluence of factors that can sometimes play into that dynamic relationship.
Definitely. And something that comes to mind, as we talk about how the correlations do change over time is the advent of credit quality and how that can act differently in different environments. So if the economy is humming along, high yield credit or lower quality debt, that can do well. That obviously yields more, and then that can change very quickly. When we see the economy start to slow in some instances and deteriorate, that's where high yield bonds start to act a lot more like stocks, and that's a big reason why we don't include them in most client portfolios, because we know that they're likely going to be correlated in some sort of downturn. Mm-hmm. The third point, fixed income offers more than just diversification. This is a big one as the Fed has continued to raise interest rates over the last couple of years.
And this one is an important one because you look at the starting yields for high quality government bonds and investment grade corporate bonds, and most of them are north of 4%. And that is very telling because forward yields are the greatest predictor of future returns for fixed income. there's not a whole lot of fundamentals or valuations that need to go behind that. It is what it is. Whereas with equities, there are growth scares, there's fundamental issues, there's investor worry, there's key man risks. Those also can all play into intrinsic values of equities. Whereas again, with bonds, what you see is what you get. There's that pull to par. Bonds always eventually will return to face value. So price return plus income yield, you get a pretty nice total return, and you're even seeing that in sort of the differential between the earnings yield of the S&P and the fixed income yields, where you're actually getting more with an all-in yield for fixed income than you would be getting from the S&P earnings yield right now.
Yeah, and that's a dynamic that clearly sticks out when we meet with portfolio managers. When we meet with equity managers, it's much more of the narrative, the story, the growth trajectory. You really have to connect, all of these dots and look well, into the future. With fixed income, it's a lot more math-based, a lot more straightforward, and it's just a clear difference there. Your fourth point, time horizon matters. This is something that is obviously important all the time, but especially during pockets of market volatility, when we take a step back and really think about how investments relate to planning and ultimately goals for clients.
Absolutely. You look at the one-year correlations for fixed income and equities, and maybe they're not all that very telling, or not telling, but all that persuasive when you're looking at sort of those diversification benefits. But you take a much longer, you take a step back and you look for the longer periods, and again, you see that the correlations do actually still come into play, and you are still getting both, equity. You're getting your equity returns, but you also have this amazing counterweight in fixed income, and again, you're getting really high quality investments to sort of play off of the risk that you're allowing the equities to take, and you're capturing a 5% clip while you're doing that.
Right. There's a lot to like there. And your final point, market dynamics go beyond Fed policy. This is something that really plays into the art and the science of what we do. Why, in some instances, knee-jerk reaction of certain headlines and certain policy implications can fall into place, or why they may not.
Yeah, the Fed policy tends to remain very data dependent, and again, their two major focuses are, maximizing employment and price stability. Inflation plays into the price stability part of that, and inflation weighs heavily on fixed income because of purchasing power erosion. But there are often times when, major factors outside of that can influence a flight to safety if people are concerned about, current growth or future growth that may lead them to going more towards cash or to fixed income. Cash is wonderful. Last year you got a good 5%, but that's all you're ever going to get. In the face of any sort of macro event, cash is not really going to help you on sort of that downside risk. Whereas with fixed income, you look at something like 2023, the fourth quarter, we seem to have gotten past some of that hump with inflation, but interest rates weren't completely off the table in terms of rate hikes. The Fed did sort of tell us that we may have a bit of a pause for a while, and that was great for bond markets.
So one of the things that really speaks to the market dynamics going beyond Fed policy is this simplistic idea of the Fed controls short-term rates, but longer-term rates are market controlled. And this is something that we saw play out last fall and even so far for this year. And a simple way to think about it, and an example of that, is when the Fed initially started cutting rates this past fall. They cut in mid-September. Interest rates did nothing but go higher since then, and really into the end of the year. That's a dynamic where we had clients say, well, I thought that they cut rates, and we had to explain, well, growth expectations changed, and that's what really drives longer-term rates. So that's going to be interesting to see how that plays out. Obviously, all eyes are on the Fed. The market's pricing in 3 rate cuts at this point. We'll see how that changes over time. Well, Sean, that was great. Obviously, a renaissance going on within fixed income, a really exciting area, just given where yields are, given how much volatility we're likely to continue to see on the equity front. And thank you for unpacking that.
Thank you so much. Yeah, I think that there's still a lot of room to run in fixed income. Obviously, it's important to stay active. You have to make sure that you're not extended in duration, and that your quality, you have the quality that you'd want for your portfolio. But with that, again, it's still the perfect counterweight to the equity risk that you should be taking in your portfolio, especially in an inflationary environment where if you need to if your portfolio needs to stay at that same level, you're going to need sort of price increase, and stocks will do that the best.
All right, Sean, we appreciate it. If you'd like to check out Sean's full blog post, please feel free to check out the link below. It'll be in the description. And as always, if you found this to be helpful, please pass this along to family and friends. Thank you.